When looking at the accounting equation, students have usually the most difficulty understanding owner's equity. When I go through owner's equity for the first time with students, the thing I focus on is the adjustments to owner's equity, WIRE, W-I-R-E, withdrawals, investments, revenue, expenses. Now some of you out there might be wondering, what is owner's equity? I know what stockholders' equity is. They're the same idea. It really depends on the type of business. So let's consider a sole proprietorship versus a partnership versus a corporation. So assets equals liability plus owner's equity. Owner's equity being for a sole proprietorship or partnership, assets equal liability plus stockholders' equity. Stockholders' equity if it's corporation. The idea of owner's equity and stockholders' equity, it's the same idea. It's the owner's rights. Even the adjustments, WIRE, W-I-R-E, withdrawals, investments, revenue, expenses that affect owner's equity, they also go into corporate with respect to stockholders' equity. Same idea. Now, of course, things are broken up. We have special rules for corporations, which is the most complex of those three entities. When you're looking at these financial transactions, we break up the stockholders' equity into paid-in capital and retained earnings. Retained earnings, you find the withdrawals, known as dividends, the revenue and expenses, known as net loss, and you also have, on the other side, paid-in capital. That's where you have the investments, money going into, with respect to the owners, contributing into the actual business. Now, sole proprietorship, just one owner. You're going to see that it's just going to have a simple capital account or owner's equity account. But when you have more than one owner, partnership, okay, and it's not a corporation, so it's a partnership. That's why I've got, of course, my Mario outfit here with my favorites, Mario and Luigi, right? We've got our good friends here. The idea is that owner's equity, stockholders' equity, it also applies to partnership as well. We call it owner's equity. We look at the different capital accounts for each partner, each owner. When we have investments into the business, we have to actually record those respective accounts, but there is an account for each specific owner. They have their own account so we can keep track of that. Of course, we want to make sure that we keep track of which owner has contributed what. When we allocate out income, loss, all these things, gains, losses, we actually do that to the different owners using the respective capital account. Of course, we have withdrawals. We keep a drawing account for each owner as well, because if one owner takes out money but another owner does not, that doesn't make sense to just we'll just take the amount. We have to actually keep track of the owner's investment in the business when you think of the idea, okay? And there's special rules that apply in each of these cases. Of course, again, sole proprietorship is the easiest of the three entities, very simple. But then when you've got partnerships and corporations, you've got much more sophisticated things. Many of you out there, you might learn about stockholders' equity, corporations, and that might be what you learn in an accounting class. You don't talk about sole proprietorships or partnerships, and that's fine. The idea is still there. But there are special rules that apply to corporations because we've got special types of ownership like preferred stock versus common stock. We've got treasury stock where the corporation buys back its own shares. We've got all sorts of crazy things. With a partnership, the same idea. We've got things like the bonus method or how to allocate gains or losses or how to liquidate. We have more than one owner, so we have to do some different methods and calculations when you have more than one owner to keep track of these transactions. Okay, so just remember the Mario suit, right? Mario, Luigi, partnerships. Keep that in mind and remember that when you're looking at stockholders' equity, owner's equity, the idea is the same. Depending on the type of entity is where the difference comes into play. And also remember that it can be more sophisticated or more complex depending on the type of entity itself.